Good afternoon, everyone. Welcome to the etmarkets.com webinar powered by NSE on interest rate futures. Interest rate futures are very actively traded derivatives contracts worldwide. In India, they are relatively new, but the opportunities they offer are huge. Today, our expert, Ms. Huzan Mistry, Chief Business Development, Currency and Debt Markets at NSE, will give you a heads up on the best ways to tap this product to hedge and make money out of it. We will kick off with her presentation now. Thereafter, Ms. Mistry will field questions from you. You can keep posting your questions on the small chat room on the right-hand side of your screen. So stay logged in and get all your queries answered. Over to you, Ms. Mistry.
Good afternoon, and thank you very much for the opportunity to share another interesting product that NSE launched in 2014 January. It's been a short 2 years that this product has been in existence. However, since bond futures is something, as you mentioned, a fairly new product on the exchange platform, what is interesting is that the risk it helps to trade and hedge, which is the interest rate risk, is possibly the most pervasive risk that individuals, organizations, entities, domestic or global, have to manage effectively, and a risk that we all live with. Essentially, interest rate comes into play as soon as we're talking about anyone borrowing or lending money, and that transaction happens whether you have a bank fixed deposit, whether you're a company who's borrowing for your capital expenditure, or otherwise it is in existence for the government of India because they have a borrowing program. It exists because you have a credit card. So interest rate risk is perhaps the most pervasive risk that any economy or individual lives with. Whether we actively recognize that risk and do something about it is obviously the question. What it therefore also provides is an opportunity to actively trade it. Given the fact that the bond futures are a fairly new product that the exchange has launched, that NSE launched, we call it the NSE bond futures. I want to briefly spend some time on actually going through what are fixed income securities, what are the different type of securities that exist in markets today, how they really compare with equity markets in some sense. What does an interest rate indicator really mean for an economy? What are Government of India securities? And then going on to some specifics on the bond and then the product offering from the exchange. As I mentioned, a fixed income security, if I really had to define it, is an investment that pays a regular income in the form of a coupon or even a preferred dividend. But essentially what I know is that if I've put in 100 rupees with a coupon or an interest coupon of say 8% semi-annually, I will get 4 rupees 2 times in the year. Some of the most common fixed income securities that probably most of us are aware of include sovereign bonds. What I mean by sovereign bonds is what the Government of India issues to fund their fiscal deficit. The corporate bond market, which corporate issuers raise funds through. Fixed deposits, Provident Fund also has a fixed rate of return as far as India is concerned. Your commercial papers, again, which are issued by corporates, your certificates of deposit, these are fixed income securities. However, an interest rate or a fixed income return is what you would even be getting if you give money to a money lender. So to take an example in the market context, as I mentioned, a fixed income security of say an 8% fixed government bond of say 100 rupee investment would result an annual payment of 8 rupees to me. And on maturity, I would get the same 100 rupees back. Let's list some of the assets and the liabilities when I'm talking about fixed income securities. So Government of India bond is a which has a fixed rate of interest at the time of issue or reissue. There's a specific coupon that is provided in terms of at what this bond will be, what rate of return this bond will give. It's a tradable instrument, so are corporate bonds. So fixed deposits are again bear a fixed rate of interest, but they're not freely tradable. Once you've invested in a fixed deposit, you normally sit to maturity, though a prepayment in most cases is promised. Your provident fund is a fixed rate of return, though it is reset periodically given its long tenure. Even a mutual fund where you're investing in a debt or a liquid fund is always linked to returns provided by underlying fixed income securities, and yes, they are tradable. On the liability side, a home loan you may have taken has a fixed rate of interest, which may be reset, so may have a floating component to it. They're obviously not tradable today. A personal loan that you may take for your car or to buy any other asset or a marketable security is again a fixed rate of interest. Your credit card, which has a particular rate of interest for the credit that it is providing you, and depending on when you make that payment, is again a type of a fixed income return. So if I compare it to, you invested 100 rupees in an equity of a company, the dividend obviously would vary based on what was the return the company made. In the case of a fixed income security, the coupon is fixed up front, and you know that it's assuming an 8% rate of return. 8 rupees is what you will get for the course of the year. Equity is obviously, there is no maturity to the stock of a company, whereas a fixed income security will have a fixed maturity, whether it be 5 years, 10 years, 1 year, 20 years, 30 years. It has a fixed period for which the security is issued. An equity share offers you ownership of a company, whereas a debt security is a loan that the company or the issuer has taken from the investor. To repeat again what I mentioned earlier, an interest rate is a key economic indicator for any country. And it's obviously interlinked in the sense that inflation is a function of what interest rates in the economy are. Interest rates are determined by what is the inflationary trend in a country. We've seen that recently, where once inflation came under control, you saw the Reserve Bank actually reducing rates. Manufacturing activity is impacted by interest rates. The cost of borrowing, which is again interlinked, of course, is impacted in terms of what capital expenditure and how my operating costs are funded by corporate borrowers. My investments, as whether real estate, my economic growth, financial markets effectively. Like I said, anything where there is a flow of funds, whether inward or outward, has an interest rate impact to it. For the corporate, again, the cost of borrowing, investment capacity and expansion, and revenue and sales all are impacted by what the interest rate at which a corporate can borrow funds. For individuals, again, inflation affects us all. If I have all my investments sitting, say, in a fixed return, which gives me, say, 8%, but inflation in the economy is, say, at 12%, then my returns are not keeping up with what inflation in the economy is. My prices of my investments in terms of stocks or commodities is impacted by what interest rates in the economy are. On any loans I may have taken, whether it's a housing loan or a car loan, a lot of India keeps its savings in bank deposits. The rates there impact what return I get on my investment. Your provident fund is impacted. Real estate prices are dependent on what are the interest rates in the economy. Your investments in mutual funds also. We'll slowly move on to explaining a little bit of what a Government of India securities, what kind of returns it gives, and how that market works, and what a bond really means in terms of yield and price relationship, because that is what the product offering is linked to. The Government of India and the central and the state government issue long-term securities. They are used to fund government expenses and cash management. It normally carries a fixed rate of return, and there have been some issuances which have been on a floating rate coupon. Recently, the government of India extended the tenor up to which they were borrowing up to 40 years. So the most recently issued bond in the 10-year tenor space was a 759 Government of India security, which matures in 2026. So what this nomenclature really is telling you, when we say 7.59% GS 2026, it means the coupon on the bond is 7.59%. It's a Government of India security, and the maturity is in 2026. In coupon dates are half yearly. Given the date of issuance, here it is August and January of every year. In a situation where I'm investing in a bond, my return is essentially calculated or determined by what is the yield on the security. It is while a bond on day one is issued at 100 and may bear the coupon, say as was the case of 7.59, a subsequent purchase or sale of that bond would not necessarily yield the same coupon, because the price of that bond, which at face value is 100, may actually move up or down. So the yield of a bond is my implied interest offered by that security over the life of the bond at current market price. So it consists of it assumes to arrive at yield, you obviously need to know the coupon. You are assuming a reinvestment of coupons when you're calculating yield, and the gain or the loss selling or redeeming it. Yield and price bear a inverse relationship. What I mean by that is that if, let's assume in the table on the left of your screen, you see yield to maturity, which is YTM, listed from 6 to 10. Assuming you bought the bond at 100 rupees and a yield of 8%. If your yield actually goes down to 7.5, your bond price goes up. What I mean is, if you've bought the bond and interest rates come off, you make money because the price of the bond goes higher. Similarly, if you bought the bond at 100, the yield goes to 8.5, your bond price actually goes down to 97.99. This demonstrates the inverse relationship between price and yield, where as prices increase, yields are falling, and vice versa. So therefore, the price and the yield, if you actually plotted it on a graph, is really a mirror image, because in a particular bond, as price goes up, there's a similar proportion to which yield will fall, and vice versa. I'll restate this for completeness. So when a bond is at par value, it's quoted at the coupon yield. So therefore, my yield and price, that's basically what you mention it as the coupon, the bond being traded at par, which is at the face value at which it was issued. In the situation where the price decreases, the yields go higher. And those would be bonds at a discount to their face value. So as in the example we saw earlier, a bond which was priced at 100 face value has actually gone down to, say, 97 when the yields went higher. Similarly, for bonds at a premium, as your yield goes lower, your price goes higher, and you're making money if you've bought the bond. Returns on bonds are also looked at from a point of view of what is called as PVBP, or price value of a basis point. What I mean by that, it's a measure to describe how one move, or a move of 1 basis point in yield terms, affects the price of a bond. So for example, I've briefly put down here the bond futures that are available today to give you a sense of what is the PVBP for each of those bonds. Our existing product offering is available in 3 buckets: in a maturity bucket of 4 to 8 years, in a maturity bucket of 8 to 11 years, and in a maturity bucket of 11 to 15 years. We have basically 2 securities in the first bucket, 3 in the second, and again 2 in the third. If you see the first example, which is 8.27 Government of India Security to 2020, it has a PVBP of 3.67. So it indicates what 1 basis point move in paise terms translates to what in the price of the bond. Similarly, if you look at the last on the list, which is 7.88 2030, 1 basis point move in that security gives you a change in price of 8.26 paisa. So basically, PVBP, if you had to compare two bonds, a same coupon, two bonds with the same coupon, one having a longer maturity, the bond with the longer maturity will have a higher PVBP. In the event that you have two bonds with the same maturity, the one with the higher coupon will have a higher PVBP. This essentially allows you to measure that if in the 788 2030 bond, if the yield moved by 5 basis points, I would make or lose 8.26 multiplied by 5. Let's now come to essentially the bond futures offering on the exchange platform. As I just mentioned in the earlier slide, we offer 3 maturity buckets in which bond futures are available. Relative to how these products are available in the rest of the world, it's a very simplified product in India. The future is quoted exactly like the underlying bond is, and it is linked to a single bond underlying. So essentially, we have a future on 8.27 2020. We have a future on 768 2023, on 759 2026, and so on and so forth. Let's look at how you would basically trade this product. So let's take an example of an underlying bond of 772 2025. The futures contract expiry date, say, was 31st December 2015, and you traded this on 14th December. The price of the future at the time was 99.35, which was giving you a yield of 7.80. If you notice here again, the price of the future being below par indicates that your yield is actually over the coupon of the bond, which is at 780. Now, the investor expects that yield is going to come off, and therefore will go and buy the future. As I mentioned, when yield is coming off, the price of the bond and the price of the bond future, therefore, will rise. You'll go and buy one lot. One lot is basically to 2 lakhs equivalent. So you will essentially pay, the value of your contract will be 2,000 into the price into 1. And your margin, therefore, at around 2.5% comes to around 4,900. On 21st December, the price of the future is 99.75. So your trade has actually worked for you, and therefore, and the yield has come down to 775. You would sell the future. The value of the same would be 99.75 less 99.35 multiplied by 2,000, which is the face value of the future. Essentially, you have made a profit of 800. I'd like to reiterate here that the value indicated at 1,98,000 is not the cash you pay, as is the case in all other futures. What you're essentially doing is that is the value of the contract that you fund through your margin. Similarly, let's assume that scenario 2, where the price of the future goes against you and the price of the future goes to 98.95. What effectively would happen is that means your yield has actually moved against you by 5 basis points. You'd sell the future and your loss would be at around 800 rupees. This does not obviously incorporate the cost of funding your margin, but the margin is essentially something that you can pay through various non-cash securities, government securities, equities, etc. Let's take an example where investor expects an increase in yield, which would mean a decrease in price of the same bond, 772. On 19th January, we put on a trade for contract expiring. The price yield is 7.77. You sell one lot. The value comes to 199,200. The margin at 2.5% is 4,980. On 2nd February, you decide to unwind the position. The price is 99, and your yield has gone higher to 785, which means you got your trade right. You buy back the future. Your profit on just the trade was 1,200. You'll obviously deduct what was your cost of funding that 4,980 margin. In the reverse scenario, if actually the price moved against you and yield actually fell, you would obviously lose money. The payoff is as it is indicated in the graph. It's a linear payoff, as is the case with all futures contracts. Let's look at how you can use this product for actually a fixed income instrument that you may hold. A lot of us actually have our investments in mutual funds, which are debt-oriented schemes. Now you normally have a holding period of 3 years because of the tax implication on the same. Now say for example you're holding a debt-oriented mutual fund, so you are basically long bonds through the fund, and you expect that the yield will rise. Now if you're expecting yield to rise, which means you're expecting that the NAV of the fund is most likely going to come off. What you would do therefore is you would sell bond futures. So let's assume just in this case that you sold one lot of bond futures at 99.60. The yield was at 7.77. The NAV of the mutual fund that day is 13.10. The futures price comes down to 99. You've actually made a return on the bond futures product. You have lost something on paper in terms of the underlying mutual fund investment. So you have managed to recover some part of your loss on the mutual fund investment through hedging with bond futures. What is important to note in this particular example is obviously your mutual fund will not move directly like the bond future will, because it will have a portfolio of investments and not just a single bond. But obviously even for us, but you need to be aware of which maturity bucket to hedge in for the least amount of impact in terms of basis risk. Because you may have a scenario where if you're holding a short-term fund, then obviously you need to hedge through the shorter dated maturities, and vice versa if you're holding a long-term debt-oriented fund. What factors affect how interest rates or how bonds move? Data released on inflation, what is the manufacturing activity, how is GDP moving, your growth rate in the economy, therefore, your RBI monetary policy stance, whether it is accommodative, whether it is bearish or bullish, therefore. Government borrowing, so your fiscal deficit obviously has a huge impact on, so the people are looking forward to what is potentially the fiscal deficit number that the budget will throw out. Crude oil prices in terms of how much it affects, therefore, directly your trade balance. FI activity, inflows and outflows in the debt segment also affect what bond prices are doing. Interest rates, like I mentioned, is the backbone of any economy or a corporate or an individual in the sense of the risk they are exposed to. So therefore, equity markets, capital flows are all a reflection of what is happening in the interest rate markets in any country. Global events, obviously, like for example, the Fed after a long accommodative stance has started raising rates, and therefore it has an impact in terms of what other economies are doing. Commodity prices, and without a doubt, what are the political and geopolitical events in any macroeconomic watch. Very briefly, let's touch upon interest rates and bond yields. So, like I said, the government bond yield is effectively your principal indicator of interest rate in the market. And the Reserve Bank of India, which essentially, when we read about the Reserve Bank having raised or dropped rates, they're really talking about the repo rate. The repo rate is the overnight rate at which banks borrow and lend from the Reserve Bank to manage their overnight liquidity. That is an indicator of where the Reserve Bank of India has set the interest rates in the overnight market. The yields on the bonds are obviously determined by actually where investors bid for these securities. You see the graph where the red line is the repo rate. It's a step function where you see it going up or coming down because it's a policy rate, and therefore what the Reserve Bank does is increases or decreases at a particular point in time, and therefore it's a step function. The blue line is the yield on the 10-year bond, which is a market determined yield, but it obviously closely follows what is. So if you look at the period from say January 14 to March 15, where there was an expectation of a rate cut by the Reserve Bank of India. So you saw the 10-year yield come down from almost 9% to a little less than 8%, about 775. That is expectation of the rate cut, which happened only after about Jan 15. Let's move on to inflation. Obviously, when the Reserve Bank and the government talk about where they want to peg yields in the bond markets, it is a big input for them is what is the inflation in an economy. If the expectation is that inflation is rising and going out of control, central banks raise rates to rein in inflation. And if it is the other way around, you actually decrease rates at the time. How do you participate in the bond futures market on NSE? It's no different from what you would do for the equity futures or the currency futures I talked about. You would select a trading member or a broker. If your KYC was completed for the currency derivative segment, the bond futures are listed and traded in the same segment as the currencies, so you have access to both products in that KYC. You post margins and effectively you're ready to trade. Very briefly, the contract specifications, like I said, they're available in 3 maturity buckets. The 6-year, the 10-year, and 13-year is what we call it. The 6-year is essentially for maturities between 4 to 8. The 10-year is for maturities between 8 to 11, and 11 to 15 for the 13-year. One lot is 2,000 bonds of a face value. So the face value of the lot is 2 lakhs. It is price based and derived from the underlying clean price. It's quoted for each contract. The tick size is 0.0025. It's traded Monday to Friday, 9 to 5. We have 3 serial month contracts. So today we have February, March, and April, and then quarterly contracts after that for the March, June, September, and December quarters. The expiry is the last Thursday of the month and the previous day in case it's a holiday. The margin is span based exactly like it is in the equity and the currency futures market. Your position limit is 6% of open interest or 200 crores if you're a client. If you're a trading member, that number is 600 crores. There is a daily settlement and a daily mark to market on this product exactly as is the case in equity futures and options and in currencies. There is also a spread trading facility where you can trade 1 month over the other. This is very briefly how this product has performed. We are seeing an expectation of lowering interest rates, obviously so much higher volumes in the 14-15 period. It's been a little more muted currently, but it's a product that globally trades more than any other asset class, and we really do believe that it has a huge potential going forward. There is on our website you may find a page which is the NSE NBF2 page, which will tell you what the contracts are trading at. With that, I will end and open for questions if anybody has any. Thank you very much, and I'd like to thank the ET team for organizing this for us and for giving us the opportunity to showcase a very, very nascent and new product to all of you. Thank you very much.
Thank you, Ms. Mistry. That was a very, very exhaustive presentation. In fact, most of our questions have actually been answered in the presentation, but I will take questions anyway. Now, Ms. Mistry will actually answer your questions. You can open your chat room on the right-hand side of the screen and shoot your questions. You can also post your questions on Twitter at #ETMarketsWebinar. So, Ms. Mistry, the first question is actually a very simple question. Mr. Surender Chirappa, he wants to know what kind of capital do we require to use this instrument? Is it a large amount or a small amount would suffice?
Thank you for the question. As I mentioned in my example, on average, the margin has been between 2.5% to 3%. So to do one contract which has a face value of about 2 lakhs, it's really not more than about 3% of that. So 1% of 2 lakhs is 2,000. So we're talking really 4,000 to 5,000 rupees is the amount you need to trade one single contract of this product.
All right. So next question is from Mr. Om Prakash Pratap. He wants to know what are the downsides that one needs to keep in mind when investing in this instrument?
Frankly, like I said, the upside and the downsides are not dissimilar to what you would trade any other asset class, whether it was equities or commodities or currencies. Bond prices obviously also go up and down. They are impacted by actually fairly similar things that impact currencies and equities. The additional parameter that obviously participants look at very closely as far as specifically bond markets are concerned, of course, is what is the monetary policy stance that the Reserve Bank of India has. So do I have an accommodative stance? So am I expecting a decline in rates? Or is it a bearish stand where because of inflation I'm expecting rates to go up? So that is, I think, one of the key indicators that people look for. The Reserve Bank raises capital for the government of India. So they regularly have auctions of government bonds, which frankly any retail investor can also participate in. That is another indicator that people look out for very closely, because obviously the size of the issuance, what is the coupon at which the auction closes, is important in determining what the secondary market yields of the bond markets are, and that obviously impacts the prices of the bond futures as well. In addition to, like I mentioned, what are the other, but for example, like I said, why interest rates are the most fundamental macroeconomic indicator in any economy. If you see the amount of movement that has happened in global markets, whether equities, commodities, and across the world, on the expectation of what the Fed is going to do with US interest rates, which have been close to zero for the longest time, has moved all markets, whatever asset class you call them, not just in the US, but even across the world. So watch macroeconomic indicator that one can talk about.
All right. We have Miss Fairy Gada. She actually, in the beginning of your presentation, she wanted to ask this question. You mentioned the price of the bond and the yield have an inverse relationship. She wants to know why is there an inverse relationship?
Essentially, what I mean by an inverse relation, see, in an equity, what happens is that if I have invested 100 rupees, there is no fixed return, right? So if the stock price goes from 100 to 120, my return is 120. 20 rupees is what I have made. Now, in the case of a bond which has a fixed coupon, so for example, on a bond of 100 rupees, the issuer is going to pay a fixed coupon of 8%. But now, if interest rates actually decline, what is going to happen is that whoever is holding the bond is going to continue to get that 8 rupees for the 100 on 100 rupees. So that 8 rupees is a fixed cash flow. But if the yield of the bond in the market has actually gone to 7%, then the price of the bond has to go up by that much so that the next buyer cannot buy it at 100 but has to buy it at 100 plus some premium, so that the return to the second investor is actually 7%, even though the coupon is 8. And therefore, because of this fixed coupon that is there, which whoever is the holder of the bond continues to receive, the price of the 100 of the bond has to adjust to make sure that the return is what the yield is indicating. So if you actually let me walk you through that example again, you can still see my screen, right?
We can.
Yeah. So like I mentioned, say for example an 8% coupon bond which is 100. Now tomorrow if the yield goes to say 7%, the person who buys the bond will still get 8 rupees from the government of India. Now, but the yield of the bond is 7. So for the price of the bond has to go from 100 to 104.16, because then that 8 rupees received on 104.16 is equivalent to a 7% return. So therefore, what I mean is when the price goes up, it actually means that the yield of the bond has come down. And that's why it's called as having an inverse relationship. The whole, basically you have to understand that the holder of the bond at any point of time will continue to get what is the coupon, which is that 8 rupees on this case. And depending on what is the price of the bond at the yield. So the coupon is a constant in the life of the bond. But what is my return on that bond? Your fixed deposit is 100 through the life when you go to a bank. But it's not a tradable instrument. So if you want to get out before your 5-year maturity of your fixed deposit, you can't do that. Or the prepayment then charges you 1% or whatever that number is. So your return gets crashed because of that. Whereas here you can actually trade this instrument when the yield moves either side.
All right. So the next question is from Mr. Santosh Arora. He wants to actually know why the rupee is sinking against all major currencies and what can actually what can stem this fall.
Well, I think that's a difficult question. It's really about what is happening to, I think, equity markets across the world. It is a function of what is our own trade balance and deficit numbers. It's a function of what are FII inflows and outflows. I'm actually going back a little to the webinar I did with you guys on currencies. But
Yes.
Really, it is really macroeconomic indicators that are determining where the rupee is going.
All right. So Mr. Ravindra Vaidya, he wants to know, can a retail investor also trade into interest rate futures?
Absolutely, 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 yes. In fact, we have several retail investors already trading and investing through this product.
All right. We have a question from Ms. Taruna Negi. She wants to know, can you explain the relationship between interest rate and forex currency rates for any country, particularly in India?
Well, essentially, there is a concept called interest rate parity. So between currency and interest rates, the principle, I would probably need a board to walk you through this, but very briefly, what it means is that if I invest in a foreign currency bond today, the return I would get on a fully hedged basis should actually make investing in both those currencies equal. This obviously happens in the case of fully convertible currencies, and therefore not specifically in the case of India. But basically, expectations on the return on a bond portfolio is obviously impacted through the currency as well. Of course, the currency is impacted by actual cash flows, importer, exporter. So, but interest rate parity essentially defines what the implied interest rate from an FX curve and from the bond curve actually need to adjust for that.
All right. Here we have Mr. Sandeep Kota. He wants to know, in the current volatile situation, are currency futures the way to go, or bond futures? Which would go give you a better interest?
Essentially, what I would like to highlight is that when you're trading whether equity futures, bond futures, currency futures, what is important to note is that the volatility in a product determines what is the margin you are paying. So, for example, I'm just taking a hypothetical example. If volatility in equities is high, to get an exposure of 100 rupees, you would have to pay 20 rupees. In the case of currency, to get an exposure of 100 rupees, you would have to pay actually, say, 5 rupees. In the case of bond futures, to get an exposure of 100 rupees, you need to pay 2.5 rupees. So, effectively, your return on investment is sort of the same if all markets moved in the same direction. Now, the call really to take is whether you are expecting equity markets to go up, are you expecting bond yields to come up? So what is the extent of the move you are expecting is what determines your return of interest. Obviously, if you take very recent past, currencies have been much more volatile and so has equity as compared to bond futures. Bonds have been less volatile. However, going into the budget, where usually the government's fiscal numbers are published and what is potentially fiscal deficit and spending expected comes in, so people look forward to that, and that usually does create a lot of interest in the bond markets and the bond futures market. Therefore.
All right. We have a question from Mr. Shrudha Ranjan Sahu. He wants to know, is there a spillover effect from interest rate futures on the cash market and vice versa?
Yes, there definitely is, because there are banks and institutional players who participate in both markets, and therefore there is definitely a direct correlation and an impact of what is happening in the underlying market, in the bond futures market, and vice versa. But right now, the bond markets are much bigger than what the bond futures market are. So obviously, the primary information flows usually from the bond markets to the futures markets.
All right. We have Mr. Samrat Lahiri. He wants to know, interest rate futures were relaunched in the Indian market by only about 2 years back. So he wants to know what is really changed in the format, and could you just give a brief description of how things have changed over the 2 years?
Sure. So essentially, the first two attempts on interest rate futures. The first launch was linked to a notional to a rate which was the real rate. The second product was actually a basket product which was defined on a cheapest to deliver principle, which is the same product format that is prevalent in the US, where this product is extremely popular and traded perhaps most actively. So therefore, we also had what was a basket of securities in the cheapest to deliver, and there was actually a physical delivery of the bond at maturity. Now, the challenge with that was that not everybody wanted to take delivery of that product because not everyone wanted to necessarily own a government bond. Also, the government bond market peculiarity as far as India is concerned is that we do have liquid and illiquid points on the curve. So when usually a new on-the-run bond comes through, the off-the-run bond tends to decline in terms of volumes and activity, and therefore tends to be more illiquid. And people who even could take delivery did not want the potential to take delivery of what may be an illiquid bond tomorrow. That restricted actually that product from really taking off meaningfully. Therefore, I think the current product, which is actually linked to a single bond, and we usually have the bond future on the run and the most liquid bond. So for example, if I take you back to my screen on our product, in the 10-year bucket, which is the 8 to 11-year bucket, the 772 is still our most actively traded bond future, the 2025 maturity bond. That is the new 10-year benchmark now is the 759, which is beginning to pick up in terms of volumes in the underlying and in the bond futures market. So essentially, the most liquid bond available in the underlying market for that segment is available in bond futures. So therefore, you are not risking an illiquidity scenario.
All right. We have Miss Ragini Verma. She wants to know, how do debt funds use interest rate futures to protect her returns? She wants to know how to use the funds basically.
Uh, uh, so basically, what you're saying is that you are an investor in a debt mutual
Yes.
fund, and therefore how to
Yes.
protect. So basically,
Yes.
like I said, if you are a mutual fund investor, first you need to know whether your fund is investing in short-term securities or long-term securities. And when you say long-term, are you really talking about in the 11 to 15-year bucket? Funds normally will definitely be indicating what are the maturity buckets they invest in. Uh, Again, like I said, if you are basically you're long the bonds in when you're holding the mutual fund. So effectively, if you were expecting that interest rates would go higher, for example, in the last few weeks, we've actually seen yield on bonds go higher. So your NAV of your funds may have come off depending on which funds and which section of the portfolio the fund manager is holding. What would then happen, as I had actually put down in the example, and I'll take you back to it, is you would essentially sell the bond future. So when you expect yields to go up, you expect the price to come off. So essentially, if your futures was priced at 99.60, if you sold that future because you expect yields to go up, so say yields today were 7.77 and you expect interest rates or yields to go higher, then you're expecting yields. In this example, I've said yield will move from say 777 to 785. Then you sell the bond future, and the gain you make on the bond future should in some portion compensate for the loss in the NAV that you see in your mutual fund scheme.
All right. So we have a fresher, somebody who wants to invest in the market now. Miss Priyanka Bhan, she wants to know what would you suggest a fresher who's interested in investing in currency interest rates and currency derivatives.
What would I recommend? I would recommend
And
first trying.
actually, it's over equities. They want to choose it over equities. So how do you look at it that way?
Uh, Obviously, I think firstly for any investor to have a diversified portfolio makes sense. So you already have some sense of an equity investment. You actually can potentially diversify your portfolio into fixed income and currencies. Again, like I said, as NSE, we obviously don't have views on whether rupee is going up or down or bonds are going up or down. So obviously, having researched a view that you want to go with, if you are thinking that the rupee is going to depreciate, you would buy the futures. And similarly, if you thought that the bond yields are going to come off, you would go long the bond futures. What is obviously valuable is that through the futures you can play both sides of the product. So effectively, if you think the market's going to go up, you can actually buy, and if you think it's coming down, you can sell and you can make money. You can obviously trade it both sides when you deal futures. What I would like to also add here, which I failed to mention earlier when I was presenting, was that the Reserve Bank of India has just released a paper on interest rate option products and put it in the public domain for comments. We should therefore hopefully in the course of the next few months be able to offer options on these products also.
All right. We have Mr. Shantanu Bhatnagar. He wants to know, how does this equation between fiscal deficit, interest rate, and bond price work? And should the finance minister keep the fiscal deficit target higher? Will it affect the interest rate trajectory? And if that answer is a yes, he would want to know how.
So essentially, fiscal deficit is defining what is the government, what is likely to be the, basically from revenue and expenditure that the government has, the shortfall in revenue is being made up by the borrowing program, to put it very simply. So a higher fiscal deficit means that the government is going to borrow more, which means that could effectively have a negative impact on interest rates. So you might actually see your bond yields going higher, meaning prices are coming off. So a higher fiscal deficit is actually bearish for bond markets, where you expect prices of bonds will come off. So obviously the finance minister, and I think one of the big targets that the government sets for itself is to have a declining fiscal deficit, or to have a smaller and smaller deficit. Frankly, India's deficit has only grown in the last several years, but as a percentage, because that effectively affects what capital in the country goes towards, because someone has to buy these bonds. So a higher fiscal deficit usually means higher interest rates for bonds, and therefore, higher yields or coupon for bonds, and therefore lower prices.
All right. Miss Neera Gun, she wants to know, why is it said that debt funds deliver better returns in a falling interest rate situation?
As I mentioned, when interest rates fall, prices rise. So therefore, yes, debt funds will do well. Now, when you pose that question, are you saying they perform better than equity funds, or are you saying that they perform well? They will perform well, because as interest rates decline, bond prices go higher, so your fund is going to improve on NAV. How equity markets will perform at the time depends obviously on what is the expectation as far as the declining interest rates will do for the corporates.
All right. Mr. Ankur Tripathi, he has an academic question actually. He wants to know what is meant by long end and short end of the yield curve, and how are they related to long-term and short-term debt funds?
So the long end of the yield curve is basically what you're referring to is the maturity of your bond, or the maturity of your security or investment. So what you mean, the long end of the yield curve is in India anywhere from, I think, 10 years to now 40 years. So the 10-year bucket is the most liquid and active one. The short end of the yield curve is really starting from your overnight to your treasury bill or T-bill rates or your CP/CD rates, etc. So that your yield curve essentially is when you draw, let's look at. So basically, no, I don't really have a graph on it, but essentially a yield curve means your overnight rate is say 6%, your 5-year rate is say 7%, and your 10-year rate is say 10%, hypothetically. You have a upward sloping yield curve. If your overnight 5-year and 10-year rate is say all at 7, 7.25 and 7.25 kind of level, it's a flat yield curve. If you have your short end of the yield curve say at 8%, but your 10-year rate at say 7%, then you have an inverted yield curve. Basically, the yield curve is the interest rate or return on investment for different tenors. So you will pay more. You must have seen in your bank fixed deposits, they will tell you for a 1-year FD I will pay X, but for a 3-year FD I will pay say quarter basis points more, and for a 5-year I will probably pay the same or lower. So that is essentially the short and the long end of the yield curve.
All right, so this is perhaps the last question that we will take for today. Mr. Pranav Tanna, he wants to know why has the bond market not yet matured in India, and what are the kind of initiatives that the government has taken or should take for the same?
So when I say bond market, I will really define it as a government bond market and a corporate bond market. So the government bond market is essentially a largely institutionalized market today. A retail investor has the ability to invest in the market. It's not that it does not, but it is still not perhaps a very efficient process. So frankly, you can theoretically go to an RBI PDO and buy a government bond should you so wish to. The government has a very definite and stated agenda of increasing retail interest in the government bond markets, and there are various steps being taken, and hopefully we'll be able to give you more information on that very soon. In terms of the corporate bond market, again, it's a very institutionalized market, but we do see a fair amount of trading activity in our tax-free bonds, which are listed in our cash market segment. They are traded and invested in quite well by the retail investor base. The corporate bond market, which is the taxable market, is again a more institutional market, but is again accessible through the exchange platform, even for a retail investor. But yes, there is definitely work to go. It does not trade as actively as the equity market does, but the bond futures are a good start. We are seeing a fairly decent pickup in activity there, and hopefully the next time we have this conversation, we'll have to talk about.
All right. Many thanks, Ms. Mistry, and also to our esteemed audience, especially those who took part in it very actively. We have not been able to take a whole lot of questions for the dearth of time. We hope to address them next time. For a link to this webinar and Ms. Mistry's presentation, do follow us on Twitter and Facebook. Have a great day ahead.
Thank you very much. Thank you everybody for joining us today.